I think there's benefit to diversifying your assets, both in terms of how we think about duration and spots on the yield curve, as well as thinking about credit. We absolutely are encouraging investors to barbell their approach to fixed income today. We agree, 5% is really compelling. So if we get into this environment where yields stay higher for longer, this is fantastic for fixed income investors. Yeah. What we want to be mindful of is there's a base case that the Fed eases 1 to 2, maybe 3 times this year, though I think they're going to walk back that median dot plot when they release the next dot plot in June. But we do have to be mindful of tail risks that are forming. So when opportunities present themselves either in munis, taking advantage of a steep yield curve, locking in some duration, or differing spots on the treasury curve, corporates which spreads are tight, but balance sheets are healthy and you're picking up a lot of excess yield, we think a diversified approach makes a lot of sense here.
You mentioned munis. I know you have some experience in munis. I'm a big fan of the New Jersey municipal bond market. Talk to us about your advice you're giving your clients these days about municipal bonds. Is it state specific, or is it just an asset class you want to have some exposure to?
You absolutely want exposure to munis. I would say both investment grade as well as high
See how
yield.
her voice changes? She's it's like, she's at Harvard and she's like, Harvard fellows, muni bonds. They're like, they trade for 1%. I mean, continue.
There's several reasons to have enthusiasm around munis. Number one, tax efficiency. If you look at yields, whether it's investment grade around a 370 or the high yield muni index closer to, call it, a 560, that's really compelling. 6% plus, 9% plus tax equivalent yields in an area of the market where balance sheets remain quite healthy. So for those of us that don't love taxes, you absolutely want to be.
So you're in a meeting at Rockefeller with Ruchir Sharma, and you're looking at the BBB- Chicago GOs.
Yes.
What do you do with the Chicago GO as they look to bankruptcy? I mean, it's like the new California.
I think
explain that to Ruchir. He's listening.
Is certainly maybe a jump from what the balance sheet looks like today. And if you look at Illinois, Moody's, Monday, the state level, positive outlook, you've had 5 balanced budgets coming from the state of Illinois. Who would have thought that, right, Tom, 10 years ago? But what you've seen in the last several years, really post-GFC, is municipalities being financially responsible. Now, you still have to do your homework, right? Bottom-up research matters. There's bifurcation in key sectors, but we think it's really prudent for investors to have that allocation to investment grade, separate accounts, focused on high grade, but also an allocation to high yield and all the opportunities
Thanksgiving dinner, you're with the fam.
Yes.
They turn to you and they say, we want to take advantage of tax-free bonds. That's the way it always goes. How should mere mortals buy municipal bonds?
Well, they should absolutely use a professional such as RAM to really focus on doing that bottom-up research from credit, optimizing yield curve, really leaning in and out of the market depending on the seasonals and
But should they be buying individual paper, Nuveen unit trusts out of Chicago,
we should buy
funds, ETFs, which?
Individual bonds for your separate account using an asset manager, and then funds within the high yield space, which is why we're expanding and really excited and enthusiastic about 3 veteran high yield portfolio managers that are coming in-house in the coming
months.
What
is this, an HR call?
It absolutely is, Tom. Absolutely.
I've got the laddered muni portfolio.
I'll bet you do.
And we talked about this last time, Paul,
did.
and you still have the ladder.
I do.
Optimize that yield curve. Let's chat offline.